All right, let's dive into MGIC's fourth quarter earnings because this one is a classic Wall Street puzzle. You've got fundamentals that look pretty darn solid on the surface, but the market's reaction, whoa, that told a completely different story. So let's break down exactly what happened and why. So, right out of the gate, here are the headline numbers that caused all the drama. On one side, you've got an earnings per share beat, 75 cents, which is a penny better than the estimate. Normally, that's a good thing. But then you look at the other side, a revenue miss. They brought in just under $299 million, falling short of the $308 million everyone was expecting. And right there, that's the conflict at the heart of this story. And boom, this was the immediate result. Before the opening bell even rang, the stock was already down more than 6.5%. So what this tells you is that investors completely ignored the good news on the bottom line and laser-focused on that top-line miss. The big question is, why? And that really sets the stage perfectly for what we're about to unpack. This is a textbook earnings mismatch. You have solid profit numbers, but the market is clearly worried about what's coming down the pike. So let's dig in and figure out exactly what spooked investors. So what did the traders and all those super fast algorithms latch onto in those early hours? Well, it wasn't really about the quarter that just ended. Nope, it was all about the signals for the quarters to come. You gotta remember, the market is a forward-looking machine, and it thought it saw some warning signs flashing. Okay, so here's the bear case in a nutshell. That $9.5 million revenue miss, to investors, that wasn't just a number. It was a big flashing sign that momentum could be slowing down. Then you've got the guidance for 2026. Management used the phrase relatively flat for its insurance in force, and trust me, that's Wall Street code for don't expect much growth. Add to that some concern that their really high persistency, how long customers stick around, could get squeezed if interest rates start to fall. And you've got a recipe for anxiety. The big fear is that even massive share buybacks can't paper over a business that's just not growing. But here's the thing, while the market was totally fixated on growth, MGIC's management was telling a completely different story. Their whole narrative wasn't about rapid expansion. It was about building a fortress, focusing on financial strength, being disciplined, and just rewarding shareholders directly. And this quote from the CEO, Timothy Mackey, it just nails their whole vibe. This is not a team that's panicking. They see their company as rock solid, resilient, and totally ready for whatever comes next. It's a message of confidence that's built on a strong foundation, not on shaky promises of future growth. And this chart just perfectly illustrates the disconnect we're talking about. Look at this. The company's book value per share, which is a key measure of what it's actually worth, grew by a super healthy 13% over the year. That is real, tangible value being created. And yet the stock price fell by over 5%. This is the core tension right here, fundamental strength versus market sentiment. So how is management actually building all this value? Well, the answer really comes down to one key strategy: reinsurance. Now, I know this can sound a little complicated, but for MGIC, it's basically the engine at the heart of their whole fortress playbook. They're not just using it as a defensive tool, they're using it as a powerful machine to unlock capital. And the process is actually way simpler than it sounds. It's a really effective three-step move. First, they do these reinsurance deals, which just means they pay other companies to take on a chunk of their risk. Step 2, this directly lowers the amount of capital that regulators require them to keep on hand, in this case by a massive $2.8 billion. And step 3 is the payoff. All that capital they just freed up can be returned directly to shareholders. Simple as that. And here is the proof in the pudding. $915 million. That is how much cash MGIC handed back to its owners in 2025 through dividends and buying back stock. This isn't some theoretical number on a spreadsheet. It's cold, hard cash in investors' pockets, all made possible by that reinsurance machine we just talked about. Okay, so we've seen the market's fears, and we've seen management's strategy. So now, let's look at what the company is actually telling us to expect for the year ahead. This is really where the rubber meets the road. And the official guidance? Well, it kind of reinforces both sides of the argument. You see that relatively flat forecast for insurance in force? That's what has the market worried. But you also see incredible discipline. They're saying premium yields will hold steady around 38 basis points, and they're actually guiding their operating expenses down. This is a picture of a company that's hunkering down and focusing on being efficient and stable, not chasing growth at all costs. And you know who picked up on all of this? The analysts on the earnings call. Their questions weren't about some crazy moonshot growth ideas. No, they were grilling management on the nitty-gritty stuff. Pricing, credit quality, the exact mechanics of their reinsurance deals, and that really critical balancing act between mortgage refinancing and keeping customers. That tells you that the smart money is focused on risk and execution. All right, we've broken down the numbers, the market's reaction, and the company's game plan. So now it's time for the final verdict. Let's synthesize all of this into our call on the stock. So, after weighing that kind of stagnant growth profile against the fortress balance sheet and those massive capital returns, what is our final call on MCIC? Our rating is market perform. And look, the company is doing exactly what it says it's doing and doing it well. But the market is also right to be cautious about that lack of growth. It's a classic stalemate. And here's the thinking behind that. The bull case is really strong. You have huge capital returns and that 13% growth in book value. That creates a really solid floor under the stock price. But the bear case is just as convincing. That relatively flat growth outlook, plus all the uncertainty around mortgage rates, puts a pretty firm ceiling on how high the stock can go. So our conclusion is that the stock is probably fairly valued right where it is. Management is executing their capital plan beautifully, but until we see a real clear catalyst for top-line growth, it's just hard to see the stock outperforming the broader market. And as always, a quick reminder, this is not financial advice. Our explainer here is for informational purposes only.